All right, folks, welcome back. This is our Thursday commentary for the ICT mentorship. This is the daily chart of the dollar index. Lost my train of thought there already. I am getting old. All right, so we're looking at the reaction off of that small little imbalance I mentioned last night, and we corrected off of that down into this small little imbalance here. I think personally that we're probably going to go a little bit lower. Watch this one here. This order block here is the last line in defense for, in my opinion, the near-term bullishness. I'm not trying to pick the top, but I think that we're probably going to want to retrace deeper. Keep an eye on this. Now, if we lose this, we're going back up into these highs, or back down into these highs, rather. And maybe even accelerate all into this. And that would be problematic for the bullishness on this market. And also, this is a long-term bearish breaker too. So I'm giving it the opportunity to prove itself, not trying to be aggressive and say, well, I'm going to call the top there, because everything in dollar has been moving higher since June. Had to deal with the consolidation here, but finally gave way on the upside. Hourly chart on the dollar. Again, you can see the reaction off of that fair value gap. And dug down into the old weekly premium high on the imbalance. And again, these blue lines here, in case you forgot what they are, this is the premium high and discount low of the imbalance on the daily chart. And if you scroll back to your daily chart, you'll see the imbalance that this is. And we mentioned it, for a while now. It's been in the charts. So let's say that the dollar index is likely to continue going lower in a deeper correction. Not trying to call a top, not trying to call the end of the up move. Okay, I'm just suggesting that, let's just say it needs to retrace. Original consolidation, accumulation, reaccumulation, smart money reversal, low risk sell, distribution. The next level of distribution in here could really send this thing down into this level here. So be mindful of that. I'm not suggesting it's going to, but it's something I'm studying myself. 15-minute time frame. Imbalance in here. Trade up into that, sold off. One more time, trade back into the discount low. Once again here, then give up the ghost. Now I want to talk a little bit about time distortion that's in these price charts. The time between 1800 hour rather, and midnight, that to me is during the time when it's accumulating, it's building up liquidity above and below the marketplace, so that way the algorithm can draw onto the algorithm could draw on that liquidity, whether it be buy side or sell side. We had this premium array here, and we kept breaking new lows. And up close candles, if you study it, all the up close candles that would be bearish order blocks have been respected. And then we had this premium array in here. Does it trade off from there? Yes. Now all of this in here is distorted by time. Even though it went lower, that's fine. But from this high down to this low, that range is not important until it becomes an element of time after midnight, which is right in here. Then this rally up to that level becomes significant. Look at the reaction in price then versus, yes, it dropped off late, in the Asian session, but it's not a lot of movement. This movement here, from this high to that low, then it returns back into that discount low. This is the element of time that's important, referring to when the market goes back to old levels of imbalance or old highs, old lows for liquidity purposes. The aspect of time after midnight, when we trade into Frankfurt and London, that kill zone time that I'm teaching you, anytime price returns back to that, or a time in the previous kill zones, that being the New York kill zone, the London kill zone, London close kill zone. Yes, in Asia, but I don't like to return back to PD arrays in Asia because Asia has its own characteristic, which is majority of the time just accumulating for the daily range. So what am I saying here? In your notes, you want to refer back to areas of imbalance or old highs during previous kill zones, not referring to imbalances, fair value gaps, or order blocks inside of the time when it's dead. Okay, in other words, outside of kill zones. In between London and New York, there's like 2 hours there. It's essentially the whole entire Asian session for the Asian range, let's say, not the session, but the Asian range. And then the movement after London close. Okay, so there's a period of time after London close, all the way up into the beginning of Asia. I'm not interested in that. Okay, so I'm not looking for order blocks in that time frame to refer back to in market structure. I'm not looking at fair value gaps during that time because the algorithm doesn't hold that much importance on that time, which is the reason why time is the first critical element to understanding what I'm teaching you, because it's time and price. So you have to strip away some of the portion of price action that is outside kill zones, which is the real secret of why I'm teaching you those time windows. It's not to trading sessions, because if that was the case, there would be just simply the trading session times that everybody teaches and what they actually are. No, there's specific elements to this time window that I'm bringing your attention to. That's where the largest volume comes in. That's where the largest commerce and exchange come in. And that's simply how the algorithm is designed to work. So notice how when we go back into this fair value gap here, like you're not looking at this, that little gap right there. When it traded up into that, that would not be, oh, it's going there at midnight and it's going to create the high there. No. Go back into the previous day, and this is during the New York session. So we have a fair value gap there in the New York session and overlap of London close. So this is a real interesting premium array. It reacts there, yes. Then it comes back to it here after midnight. Now we're in that time window again when it's going to be sensitive to significant PD arrays. Where was the last one in the New York session or London close? Right here. And this old high right here, which is a rejection block. Right there, it trades into that. But returns back to the fair value gap. Now, when you see things like this, it's easy to discount it and say, well, you know, whatever. But you need to go through your charts and look at what I'm referring to. Block out the areas on your chart with a rectangle that is not a time window that is sensitive. In other words, after London close, all the way to the beginning of the Asian range. You're not looking for PD arrays and all that. So that's where the time distortion really kicks in. Now, there are times during the kill zones where you'll have consolidation and there's distortion that takes place there. Usually that's attributed to a high impact news event that's looming on the economic calendar or that day or the day after. Or there's high degree of manipulation and you have to refer back to the crosses for that. So this is why I'm saying that you just can't come here, watch a video and think you understand this, and then or come here, come in for a few months, not even become charter member, throw live money in there because you need to support yourself financially, and then when you fall on your face, that's your fault. You're trying to drive before you've learned how to drive. You're trying to fly an F-16 fighter jet, and you've never been in the cockpit before. So it's not surprising when you see people say, well, you know, I tried to do this and it failed. No, you failed. The logic doesn't fail. These concepts don't fail. Your aptitude is the failure. You can't do it yet. It's not to say you'll never do it. It's not to say you're going to fail forever. It just means that you're impatient. You're not following the instructions when you joined. So time distortion, there's two elements to that, okay, or two stages of it. One that takes place during the kill zone, and that's attributed to economic calendar, which is why I taught you in the beginning. Focus on the economic calendar. And also market profiles. Is the market in trending model? Is it in a consolidation? If it's in consolidation and it's the dollar, that's your tip off. Go right to the crosses for trading purposes. not to trade euro pound, but to trade the crosses, like Aussie yen, and use the differentials there. Okay, so there's a choice that you have to go through, and you have to go through the analysis aspects of knowing what makes a market consolidated, what makes a market that is holding for a economic counter event. That's experience, seeing what it looks like. That's why you have to see it over the course of 12 months. You'll see that there are times that high impact news can cause the market to freeze up, and the event comes out, usually FOMC or some kind of rate announcement or something that degree, and then you'll have the market release. But while it's doing that, they will use that holding pattern in dollar or similar pattern in another currency to manipulate the crosses. So time distortion is a real event. There's a way of measuring when it is likely to occur, so that way you can prepare for it, not be surprised by it. Or if you are trading and you overlook the idea that it could potentially be taking place in the market you're in, then you can either get out of the trade, save yourself some misery and loss, or reduce the leverage that you're in on that trade, and then try to trade your way out of it if there's a little bit of drawdown. But the main thing is you want to be prepared as much as you possibly can, looking for previous kill zones and the PD arrays that exist in them. So when I teach you areas where we're not interested in, where it's like where the market's just simply not willing to produce anything that's significant in terms of price delivery, when I'm looking at price, I'm ignoring that. Okay, I'm looking at the times that I expect to see sensitivity. Now, I don't draw the lines vertically and draw boxes on the chart like I do when I'm trying to teach you something or illustrate something to you, because I want your focus on a specific area. But you all know what the kill zones in here are. So if you put those lines vertically on the chart and label them, anything between the kill zones, that is a time when time distortion will materialize. Any other time will form when the economic calendar basically provides the catalyst or reasons why it would enter into consolidation, and it becomes choppy and messy. And that's distortion by time. The way you work with that is you want to look at the last dealing range. And like, for instance, when we got past London close on the 17th, right in here, this was the low, and we just started going sideways in here. This low to this high, that's your dealing range. So what premium array exists in there? Right here. Okay, you see that? So that level of premium array, you extend that out in time. And forget all of this. Okay, this is all sloppy mess. And then when we return back to that level there, after midnight, now we're in what? We're in a time window of Frankfurt and going into London. So what does that time window usually create if you're bearish? The high of the day. What's it form? The high of the day. What's it forming on? What's the backbone behind that high forming? The previous New York session London close overlap premium array. This is fair value gap. You see how that all ties together? Now, you can't learn that, obviously. Like if I sat down with you the first time and said, all the things I said in this video, think about what you probably have overlooked in terms of what it takes for you to understand what I just said. Because it's easy once you have all these supported lessons, and well, not supported, but supportive lessons around the things I've talked and touched on in here, in this portion of the video. You take no consideration for how much time you study the kill zones and when they form highs and lows. Okay, it took time to do that. It wasn't just simply me saying, here, it begins and ends this time, and you know everything about it. No, you haven't gone yet into the chart to see, do these things create highs and lows that are significant during that time period? And then you didn't study, without seeing the kill zones on your chart, those periods of no activity between London close and Asian range opening. That's all like illiquid time. That's distorted by time too. So we're not looking for any kind of PD arrays in that time window. Even though your chart has all that data in it, I am not referring to it with any real significance placed behind any of it. Knowing what dealing ranges are, again, just my stating the words doesn't give you the understanding. You have to look at it and study. And dealing ranges are specific to kill zones. Okay, what's the highest and the lowest swing points in the New York session, the London session, the Asian session, London close. And those ranges, inside those ranges, there's where the PD arrays are going to exist that mean something. That's the algorithm is reaching back to those time windows and then those specific elements in price. Everything else outside of all that stuff is distortion by time, because these charts are marking time. No matter what price does, if it just moved around for 2 pips, it's going to create that fluctuation. And that fluctuation means absolutely nothing. But if you refer back to the previous dealing range, high and low, in the previous kill zone, it pulls context immediately right back into the marketplace. And you can decipher what it is that you're supposed to be looking for. So anyway, with all that said, again, we're not done with time distortion. It's just I wanted to touch on it again this week, and this is another element of it. And I gave you the 2 stages of what makes time distortion in price charts like this, because these are time-based charts. This being a 15-minute time frame, whatever that 15-minute interval shows in fluctuation, high and low, whether it be a lot of volatility or low volatility, it doesn't make a difference. It's just only going to mark the beginning, the highest and the lowest, and the end of that time window, that 15-minute interval. That's insignificant information. You don't have enough data there. But when you refer back to previous kill zones and the PD arrays in that, and you bring in bias, what was the bias? Well, we already completed the weekly objective that I outlined for you and went more. Mine was here, and this was extra. But I said it could possibly, be done for the week, and this was, in my mind, something to be paying attention to. And we pulled off of that considerably. So if we have a likelihood that it's going to likely retrace, are we bullish? No. Are we exceedingly bearish? No. We're just looking for it to pull back. So in this regard, this premium array and every low being taken out and every up close candle is holding price at bay. It won't let it rally. So what's institutional order flow suggesting in here for dollar? It's bearish. So cut through all the chaff and the noise between the kill zones and go back to the PD arrays that matter during the New York session, the London close session, and the London session. So by doing that, it gives you an X-ray view as to what price is likely to key off of and reach for. And if you have a bias, whether it be short-term or longer in nature, it gives you the context to work within, whether you're going to be a seller at premium or a buyer at discount. All right, Eurodollar daily chart. And I said we'd likely pull up into this here. We've created more or less the low of the week. My expectation is we probably have made the low. We don't likely see a deeper run tomorrow. But be mindful of this little area up in here. And we could see, again, more lower prices on dollar, and that would send us back up into this area here, maybe retouch the 114.20, 114.25 level. And you can see the imbalance that exists in here with relative equal highs. And it just looks like we're just starting to accelerate, maybe run right back up into that on Friday. If it overshoots that old low, we have this imbalance in here as well. 15-minute time frame. Market maker buy model in here. Original consolidation, distribution, redistribution, smart money reversal, low risk buy, accumulation, reaccumulation, another level of reaccumulation, and then starting to rally up. So we do have liquidity around that 113.85 to 113.95. So watch and see if it wants to make a run into that aggressively. Kind of like something like this, but on the upside. That'd be a nice short squeeze. And here's cable daily chart. Dug deeper into this sell sign balance, buy sign efficiency. And this one here on the daily chart, I don't know what it's reaching for, except for this small little short-term low, it has that much more of the upside to go. And we have buy side. Well, these relatively equal highs here. To me, it looks too clean. If it gets up there, it doesn't mean that's all that it can trade to, but look at this gap here. What do you see on the other side of it? See that? Balanced price range there. So it could clean this area up and then bang into this area here and pretty much be in rate term high. Or if it runs through this high, then we get obviously more downside for dollar. Long story short, make it real easy for you. Near term, short term bearish dollar, long term holding out whether or not it wants to continue higher, but it did hit a premium array in the form of a bearish breaker. British pound, this is likely to go higher to the areas I'm showing you in here. We have a small little gap there and in here. And yesterday I mentioned this one here, and we ran right up into that, overshot it by a little bit, and then sold off into this imbalance. So that was a trade idea that you could see right there panned out. If you look at how we went from this level, which was over here, then sold off to this level here, which is a discount, and then using this range here, if you bought in here, we're going to look to see a possible return back to that same imbalance, which is here. So short, buy, short, or sell the long. 15-minute time frame, again, imbalance, bullish order block, trades down into that. Look at this right in here. Small little gap there, breaks down, swing lows taken right there. See that? You don't need this one broken, just this one, because the context is that was the premium array in that imbalance on the hourly chart. We broke down, rally back up, small little imbalance there, optimal trade entry, and look at the bodies respecting that gap. This is the premium high. Perfect. That is perfect signature. When you see that kind of stuff, that is encouraging. So at that moment, where do you see price reaching for? Well, you have relative equal lows here, and then you have this gap here, and this gap, discount low and premium high. That was on the hourly chart, but it's refined to this on the 15-minute time frame, and it trades down into that order block there. So selling short here, drops down, one more time pumps into this imbalance, and then a nice run into this imbalance. Then accumulates in here and runs right back up into that imbalance again for consequent encroachment, which is where the bodies are basically residing. All right, folks, the NASDAQ 100. So here we are, another one of those hindsight things where the things I outlined, what to look for, pans out again. And this is mentorship. This is what I'm talking about. By guiding you, suggesting what to focus on, so it gives you the bias. You don't go in there looking for tops, okay? You go in looking for longs to run this high out, okay? So we've completed that. Now the question is going to be, where is it going to go now? ICT. We've never been here before, so the moon, okay? I don't know. It could go anywhere. It could literally start going into some kind of parabolic run higher, and with the velocity that would tear a face off of somebody, and it could easily produce something like that. It's producing the relative strength across the averages, so it's performing on the upside better than SMT and in the Dow. So I don't know. If we lose this high here and we take out Thursday's low, that's bearish. There's no reason to come back down below that. So as long as we're above Thursday's low, this thing is bullish. On the hourly chart, again, that's that old daily high. Buy side resides there. I said that's where we're going to draw to. And we consolidated in here. I said we're not done. I think we're still going to go higher. And we were up. And then at this point here, we'll look at this on a 15-minute time frame also. But notice that we're creating higher highs here ahead of the stock exchange open at 9:30. Then we have a decline that trades back down into what you'll see is a order block right here, but I'm anchoring it to a 15-minute time frame. But if you draw it over here, it's this order block too, but it drops aggressively in here with SMT. Now, I got an email from one of the students that said they were frustrated because, number one, they look at SMT and they don't know what direction it's looking for or assisting them with. And SMT is not a timing tool, and it's not a directional tool. Okay, it's a confirmation tool. Okay, it confirms accumulation or distribution. That's all its usefulness is. It's nothing beyond that. So just don't try to look at a hammer and think of it as a screwdriver. Okay, that's what you're trying to do sometimes with these tools. Not this student, but some of you in general that come in, they fly through the content and they don't really listen to what I'm suggesting about it. I'm giving you a lot of details and logic as to why these things should work, why they would likely fail, where they will, and how to get through those instances, and what tools are useful at what time. When you hear me teaching like that, it's boring to you because you want something XYZ, 1, 2, 3. This is the way it is. It's never going to be any deviation from that. And I know exactly it only works this time of day, and it always works without a loss. If you're honest with yourself, some of you are like that. And that's normal. I felt the same way. It should be black and white. It should be binary. It's not. So you have to come up with rules that make your model binary. Let me say that again. The markets are not going to move in a binary sense because there's so many variables and things and time elements and manipulation that comes in the marketplace. It is not binary. Your model forces a binary perception of price. This or that. Buy or sell. Trade, sit on your hands. Hold, get out. You have to have these binary functions defined in your model that makes you come to these conclusions. And they have to be well written, refined to the degree where you know what you're looking to do and why. You don't need a long speech around everything you're doing. That's the understanding that comes by being with me. But once you understand these specific signatures, you don't need a long-winded note-taking session when making your model because you know the logic that makes a bearish breaker a bearish breaker or a bullish order block a bullish order block. Okay? So, and the overall structure of a market maker buy model, which is what we're looking at right here. Do you see it? Consolidation, distribution, redistribution, smart money reversal, low risk buy, accumulation, reaccumulation, another level of just accumulation rather, and then once more before we clear the original consolidation out. Okay, all this sideways action, there's buy side builds up around that. Now you don't see this logic and framework in that daily chart. Notice that? You just see a market that keeps reaching up to an objective we were looking for, which was this old high. But when it retraced down here, I gave you this in here, all of these price points are discount arrays. Every time the market drops down, it's creating a Judas swing. It's dropping down to accumulate new longs. When should it drop down? After 7 a.m. New York time. That begins the New York session. The AM session for equities or index futures, or in this case, the CFD of the NASDAQ, it's 9:30 to noon, and then 1 to 4 for the PM session. So it helps you divide the day. The order block in here, when it drops down once more, notice we're going up in here, we're creating higher highs. We're going to look at that in relationship to the Dow and S&P. They were not supporting that higher high there. That created this retracement. That's what you would be waiting for. How far will it drop? Well, you have this order block, and look at the low to high. Deep discount array, and it's a Judas swing, and we have yet to clear the buy side. So this is all manipulation to wash out traders that are long because they don't want them to participate in that rally. And here's a 15-minute time frame. 7 a.m. That's like a midnight divider, okay? Think of that for trading index futures. Put your 7 o'clock in the morning line on there. When you're bullish, you want to see a drop down into a discount. Over here, vertical line would be right here. You're bullish. We've been bullish. Do we see a market dropping? Yep. Judas swing. Okay. You want to see that signature because it's going to invite you to seek a long position when everybody else is going to see a market just tanking. This one today really dove deep. Order blocks are sitting right there. Ain't hiding from you. Small little fair value gap right there. And your order block trades right down into that. Rallies away. Retests that level there. And then off to the races, exactly where I said it was going to go, where you knew it's been going for a while now. Now, left-hand side, we have the NASDAQ 100 hourly chart. We have higher highs here. And the SMT, we have lower highs. And the Dow, lower highs. I know it's hard to see here like this, but when you look at your own charts and compare them, it's pretty obvious. And we'll look at the 15-minute time frames a little bit better. But the market tanks. Notice what's happening here. We're trading into the order block here on the NASDAQ during the New York session Judas. When we're bullish, this is tanking. Over here, the S&P comes completely below the relative equal lows for a low resistance liquidity run signature. See that? The higher low on the right of the low. It washes that out. The Dow just trades lower. And this one is decidedly weaker. It just keeps going lower and lower. We have divergence across the board on these highs. You can see it right here. The S&P, the Dow, and the NASDAQ have not confirmed the highs. So that's why I'm expecting some kind of a blow-off move where it goes higher and then prices in some significant important high. And if these don't catch up, we could see a pretty wicked drop on NASDAQ. I'm not suggesting going in there trying to capture that. I'm just suggesting that you need to be prepared for something that bad because it could happen. I'm not saying it's the top. It just means that we could really see a wicked reversal that takes out a lot of these lows here, here, and here. And the 15-minute time frame. NASDAQ, higher highs. See that? Same highs in S&P. It's not going higher. Where this went higher here versus that high, this high is going lower versus this high. This is heavy, heavy, heavy distribution. Another level in here, high, and then lower high. So we're not seeing communication between the averages that would confirm that this higher high in NASDAQ is valid. So this is a stop run here. It's going to go down. Now, you can use this two ways. You can sell short. I shorted here, bought more, and built a pyramid up in all of this here, and then in here as well. And I'll show you, the result of that today. But over here, this dived down. While it did have a nice retracement to make a higher high, it hasn't shown much in response to the higher high that's seen over here. Because, as I showed you on that hourly chart, it dug down into a discount bullish order block on the hourly chart on NASDAQ. And this low was higher. Let me go back and show it to you. We had the low and the higher low there, where we had the low and the lower low there. See that? These are lower, these are higher, and these are lower. So which one's the stronger? Clearly, the NASDAQ. So it's unwilling to go lower. So the algorithm is tipping off smart money, saying, okay, this is the one that's, you want to pour your money into this one and go long, and it rallies up higher and stronger and outperforms on the outside. Even though this was here, that SMT divergence warned of the Judas swing that is seen on all three averages, and the Dow just couldn't even come back to the old highs here. But this decline in here showed SMT divergence here, warning of a retracement lower, and this being a stop run. Then, after the decline, we go into order block and it confirms a bullish SMT divergence. It's confirming that accumulation is actually occurring down here in NASDAQ versus the S&P went lower and then the Dow went lower as well in response to its hourly chart. I know it's confusing and I know it feels like, it should be so simple. You listen to me say it one time and you understand it. But the only impediment you have is you're trying to force SMT to talk all the time. Okay? And that's always been the case. When I was teaching it on SMT studies on YouTube, everybody would look at the wrong lows or the wrong highs, or they would look at things backwards. And they're trying to make things fit a move in the price action. When you just have to compare relative highs and lows with a underlying bias. So now think about what I'm going to say here. This is the beginning of the New York session when it's running up like this. At 7 o'clock, you're expecting a Judas swing. What has it been doing up to 7 o'clock? Going higher. So if you're trying to buy a deep discount like smart money will look to do, were we not bullish on NASDAQ? Have I not been telling you where it's going to go? I told you it was going to go to a new high. I did not suggest that we were making a high, okay? We were looking for accumulation and to buy. So when you're trading index futures, you want to treat 7 o'clock in the morning the same way we do midnight at New York in Forex. That's not to say there isn't setups in the New York session, the London session overnight. There is. But if you're an index trader, the majority of the volume is coming in during the New York hours. So if you are a New York session mindset trader, regardless of even where you live at, whether you trade the New York session in Forex or if you trade it in index futures or CFDs, you need to anchor your expectations around that 7 o'clock hour. Because if you're bullish, don't take my word for it, folks. I don't want you to just take it and say, oh yeah, I believe because he said so. Go into your charts and see when we're bullish or when you see price obviously going higher. Put a line vertically at 7 o'clock. And when you're bullish, you're going to see a Judas swing drop down. It's going to an order block or it's wiping out sell stops or reaching into an imbalance. It's going to a premium after it goes down first. So we're getting that Judas swing. We've had Judas swings just about every day this week. So again, you have to know where it's drawing. Where is it likely to get pulled up to or pulled down to? And is it being anchored on the logic around the higher time frame? Yes, because I did it on the daily chart. I showed you that we were reaching up into the daily high here. We're down here. It's going to go higher. It's going to go higher. It's going to go higher. This is just a small little blip in the individual up move. And a down day is welcome because that gives you the strength to go higher the day after or the very next day. Well, there you go. Boom. And it pumps up into the level we were looking for the buy side. Folks, this is not hard if you listen to me. I'm taking your attention to where it's likely to go. But then your job is to go in and take these individual components and pour them into your charts. In hindsight, that builds pattern recognition. Once that pattern recognition has established itself, and it takes months to do this, then when you get into the lower time frames and you're watching them live, you can anticipate these drops down just to accumulate longs and then deliver where we're looking for. But if you're zoomed in on a 1 minute chart on all of this is going to feel like the Armageddon. Okay, the world's ending. 70, 90 pips or whatever dropping down like that. It's going to feel like your face is being ripped off if you're trying to go long. You have to take a step back. In all the framework you see here, market maker buy model, in this drop down, we did not yet take out the high. So this is dropping down just to a discount. Order block. Order block on the 15-minute time frame. Digs into that. Starts to rally up. If you go into the 5-minute chart, you'll see more details in here. We can use smaller bullish order block after it creates this short-term spike in the order block. Then we get into this retracement after it retraces consequent encroachment. This low, this high, trade right into that, accumulates more. Look at the lows in your S&P and NASDAQ and Dow at these lows in here. Low, low, not low. That's the Kraken correlation. So I got a question also. Why does the averages not agree? Like, what's the reason why SMT even forms? What causes that? That's the understanding I got, or at least what I thought the question was being framed around as by the student. And if that's not what I garnered from it correctly, please send me another message and I'll quickly do it again. But I think if I understood you correctly, the question was, what makes this SMT divergence right here versus this? Lower highs, and higher highs. What causes that is the algorithm is going to reprice higher when one or more of these three averages and not reprice equally to signify that that is an area of distribution. So that way people that are in the know, okay, that they're in the know, they look for that as a confirmation that they should either be getting out of longs or going short. They all drop. Notice that NASDAQ drops down about 90 pips or points or whatever handles. And then we have this lower high here, and it really escalates on the downside. And then the Dow really falls out of bed too. But the one that's underlyingly more stronger to the upside, in other words, more bullish, which is signified by that hourly chart, the NASDAQ failed to make that lower low there, which is what you would be expecting because we were looking for a higher run on NASDAQ. We're not looking for the underlying strength to exist in S&P or Dow. We've been focusing on what index? NASDAQ. Did I have your attention on the S&P? No. Did I have your attention on the Dow? No. That's not coincidence, okay? I'm teaching you by example. I'm taking you into the charts. I'm putting you right where you need to be looking. Yes, there's moves happening in the Australian dollar, okay? There's moves happening in crude oil. There's moves happening in gold. Bitcoin's moving around too. I could care less, okay? Your idea of focusing on one thing for the time being to learn. Once you understand how to do it, then you can go anywhere you want and play, okay? But you have to know how to look at related or closely correlated markets like these three averages are and be able to ferret out which one has the strength and which one has the weakness. And then what does that mean in context? Well, I gave you a lot in this video. I told you how to frame your day and build your routine for the day. Remember I said I was going to talk about that this week? Every single day, if you're going to be studying indices, and you should be, in the fall months, you should be taking some of your time and allotting it towards these three averages. And do it until around, I don't know, maybe the first week of February. And then relax and don't do anything for a little while with it. Go back to watching Forex, okay? And maybe commodities. But the fall months, you really want to be focusing in on these three averages because the volatility, the opportunities, the setups are just beautiful. They're really, really nice. And they provide a lot of momentum and velocity behind specific price moves. So your day, when you begin, should you be a New York session trader? And I really advocate for that because it gives you all the advantages of having London behind you. Yes, there's a lot of you in here that want to, beat the brakes off of London. There's nothing wrong with that, but just know that there's an inside advantage over New York versus the London session. London session can get, well, you might think you have it, and then it takes it from you. And then for whatever reason, when I was coming up and trying to teach myself to trade Globex, trading the S&P market overnight, that's what we used to trade, the Globex market. And I would look at London sessions, and sometimes I would take a loss, and it would completely debilitate me, and I couldn't do anything in New York. I would be afraid because I took a pretty good lashing, overnight, and I wasn't able to sleep because of that. So in the 90s, that was very hard for me to overcome. To avoid that, don't think that you have to have some kind of badge of honor, like this kid ego stuff, where you're a London trader and you're getting the high and the low of the day every single day. You don't need to do that. Use your time equitably and sit in front of the market when it's the likelihood of delivering the highest probability and odds in your favor. That, my friends, is simply 7 o'clock in the morning to 10 o'clock in the morning. That sweet spot of time. And it's not even a lot of time. But that whole period of 7 a.m. to 10 o'clock in the morning, that right there, that gives you all you would need. And if you want to advance into the 11 o'clock hour, just to give you a little bit more cushion into the London close for the reasons of Forex2 confirming certain things, then do it. Let's talk about a 4-hour window. You only need 1 day a week that has the economic calendar behind you, your bias, the technicals, the Judas that delivers based on that bias. That's it. Your whole work week is done. There's a book that's out there, a 4-hour work week. I facetiously used to say to my oldest sons, I said, look, this is like that book, 4-hour work week. You only need to find one of these. And because there's a lot of moving parts to this logic that I teach you, it's real easy to get captivated by something new you just recently learned. And because you liked it or you liked the lesson I produced and taught it in, it resonated with you. You want to bring it with you. It's like your security blanket. Well, I like that, so I want to put it in my model. I want to put it in my trading. SMT can't be forced. Okay? The divergence at key highs and lows, you have to have the expectation of this forming. Otherwise, the fact that it's doing it means nothing. And I'll say that again. We have been bullish on NASDAQ. I've not taken your attention to S&P. I've not taken your attention to Dow. I've been putting your attention right on NASDAQ 100. I said, focus on that high because that's where it's likely to go. I believe it's going there. Today, it delivered. Okay? I'm not patting myself on the back. I'm literally holding you by the lapels right now because some of you are very stubborn and you're doubting and you're concerned and you're worried. Okay? You need to relax. Remember where you are. I'm telling you what's going to happen before it happens, and your charts are printing it later on. That has not stopped. The tools that I'm teaching you are working. They're delivering. They're showcasing themselves. But you're trying to make them do things they're not designed to do. SMT is not directional. SMT is not timing. It's confirmation. The only thing it does, and it does exceedingly well, is it reveals accumulation and distribution. What am I saying by that? Well, when we're looking at these lows, relative low here to here, this is being accumulated. Why? Because it can't go lower. At the same time, this low is being violated here. This is under heavy distribution. The fact that this low was taken out by that one gives you the indications that this high is less likely to be taken out, whereas this high is easily going to be taken out in the high that it formed prior to the decline. So it's going to be easier for this market that showed accumulation on the lows. It's going to be easy for it to springboard higher and reach for new buy-side liquidity. Whereas over here, this low being taken out with this one, this is an SMT divergence in the sense that this is a negative and this is a positive. This was unwilling to go lower than that low. Where this low was easily pierced by this one. And notice while it did come back, it didn't make an attempt to get through this high as quickly as this high was completely overlapped and ran higher. And the same thing can be said with the Dow. The low here, crushed. And it couldn't even come back to the old high here. This one's really weak. So, SMT qualifies, confirms. It gives you the final check in the checklist of, okay, I'm expecting this market over here, the NASDAQ, to be bullish. If that's the case, if it's dropping down, at the same time this thing is just careening lower, this is going lower, this one should not go lower. Where should it stop at? Somewhere inside this order block, because that's your discount array. Now we have SMT, we have a bullish order block. lower lows in SMT, lower lows in Dow. It does not mean wait for this one to go lower too. Big, 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 big paradigm shift right there. When you see this thing dropping hard, don't forget, this is why you have to write down your plan. What's your plan for the day? I am looking for longs in NASDAQ. I'm looking for longs after 7 o'clock in the morning. I'm looking for a decline into a discount array. I want to see the NASDAQ not go lower than the S&P and the Dow. Now, some of you might hear me say that, oh, you're only saying that, Michael, because it's what happened. No. My attention has been on the NASDAQ. I said it's going to go higher. You know, because of the lessons I've taught in this core content, that if we're looking to go long, we want to be buying the low or very close to it. In indices, you have a high rate of accuracy by putting a vertical line on your chart at 7 o'clock in the morning New York time. And then, if you're bullish, you want to see the Judas swing occur after 7 o'clock in the morning. That's when it's going to form. It doesn't mean that there won't be another lower low formed at 9:30 when the stock market opens up. You can have a real big volatility event where it washes out that short-term low that formed not long after 7 o'clock in the morning. And there's nothing wrong with that. You might get stopped out. You might take a loss. But you still stick to the idea that NASDAQ is the one I want to be buying. And it's giving me the indices support by having weaker prices and lower lows being formed in Dow and the S&P. And I should not expect to see that form in the US 100 or NASDAQ. And that's what you have here. When I taught you relative strength analysis in here, not the indicator relative strength index, the relative strength analysis, this is what this is. When you're bullish, you want to be buying the one that fails to make lower lows. When you're bearish, you want to sell short the one that fails to make higher highs. Whereas we had higher highs here. Yeah, it dropped, but not by much. You don't want to sell short the NASDAQ with the expectation that's going to be the overpowering outperformer when you can compare the S&P, lower highs, the Dow, lower highs, big decline, really big decline. Yeah, tradable decline, but hold on to it too long and it's going to rip your face off. Do you see the difference there? There's a glaring characteristic contrast between what I'm showing you here in the NASDAQ versus the S&P and the Dow. You will not fully absorb it, especially for the 2021 group. You're going to look at this and say, it's just going over my head. Something's just not right. He's not teaching it good. And I'm teaching it perfectly. The problem is you have not been supported by all of the other lessons that this requires you to know that's already taught in the core content. And where all of you are, everyone in the mentorship right now, regardless of whether you made your next month payment or not, you are all at the point where you would know these things. Because I've harped on it in the commentaries daily and multiple times a week. It's in core content lessons also. And it's in the commentaries from each month core content. So, I covered daily routine. I covered time distortion. I delivered again this week with in regards to where these markets would likely reach to. I'm not real happy with the dollar and the euro side because they went a little bit further than I wanted, but that's okay. I'm just revealing I'm not beating myself up. I'm just saying I wish I would have spent more time looking at those charts on the weekly because I never looked at the weekly and I completely missed it. Otherwise, I would have gave that level to you on the dollar. Let me take you back up to it. Actually, let's go back to it this way. This here, I would have seen that if I would have been studying the weekly chart earlier over the weekend, but I didn't see it. So by not doing that diligent study, I missed that opportunity. Otherwise, that would have been really cool because I would have said, that's what we're going to look for the weekly high. But it's still delivered here. I even had the weekly chart. I just didn't even see it as possible because I wasn't looking for it. Once I put the annotation of this line here on the chart, I just got busy talking and just never really worried about doing anything beyond that. And personally, it's okay. If the market runs up here and hits that level and that's allowing you profitability, Who's going to argue with that? And that's really what I want to get at, because sometimes the markets, I'm getting out at really decent highs and lows, but it always goes a little bit more. This is one of those instances where I'm talking about where it happens. This is it. I may never fix it entirely. May never really improve it. But my question to you is, would it matter? I don't personally think it would matter, but my obsessive compulsive disorder makes me make a big deal out of it when it's really not that big of a deal. Especially if you're developing and you are able to find the moves and see the directional bias and the draw and liquidity and what you should be expecting to see in the daily range. All these things come together. It's like a beautiful tapestry where the individual threads are what you're becoming accustomed to in the core content. You're holding individual threads. And then as you go through each month and new week of commentary, I'm teaching you how to take these threads and put them together. And at the end, when you come to your own model, you'll remember these threads individually, but when you take a step back and look at it, you're going to see something really beautiful that you yourself are going to love and respect, because you put the labor of love and effort into making that model unique for you. And if you share it with somebody else, they're not going to see it the same way you do. Oh, that's neat. I don't like that part. Why'd you put that in here? I had this instead of that. And if you are cynical and you listen to people like that, or if you have that mindset, first of all, it's stupid to have that critical opinion of someone else's model. If it's working for them, there's no reason for you to give your opinion, because I can tell you right now, nobody's opinion about what I use to trade with matters. None. And once you get your model, you're going to see beauty in it like it's your own child. Like you won't see any flaws. You'll see strengths and areas that are not as strong, but you will not see weaknesses. And that's important. It's not overconfidence. It's, appreciation for your creation. And once you have it, and you have it dialed in, not only on paper, where you have it spelled out what you're doing, why you're doing it, but internally, it matches your personality. It matches the psychological makeup that makes you who you are. And what does that mean? You're not trying to be a system trader that uses higher time frame, long-term position trading and trying to trade short-term intraday fluctuations. It won't work. So by having all these things work together, but taking small bites of this thing as you go through the mentorship and you spend time as a charter member, trying not to rush. It's so hard. I know. You want to make money. I know. But you have to figure out the things you're going to do that's going to mess you up and then fix them. I can't fix them. No other person out there is going to fix them for you. But once you've done the work to replace them with good habits, then you have the potential to do the right things and see the results you're looking for. But even then, you got to grow. And then once you do those types of things, you get experience that can't be bought. You can't put a price tag on either. You can't, like I can't put a level of money on the things I've learned in my experience that I have right now, that I can't even find a way to articulate. Like there's no words that can really explain what I'm really tapping into. I just know the painful lessons, they are meaningful to me. And they help me do the things that you see the results of. I sit out here every single week with you, and I more or less mark out and map the market for you. Yes, you can argue and say, well, that's not trading. That's not doing anything. Okay, well, let's go over. Once you know what you're looking for and you have a model, maybe you have two models, like I have several, okay? You can look at fast markets like the US 100, NASDAQ, and you can work inside this range here all day long. And this is a 30-second chart. There's so many things in this chart that exist on all the time frames we've looked at. And you can be a seller, a buyer, reaccumulate more buying, pyramid, 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 sell. Wait for the retracement down on that hourly chart. buy it. Consequent encroachment, buy it. Add more, SMT, fair value gap, buy it. Wait for this run on this high. Boom, sell it. And you build and you pyramid, you build and you pyramid, and you build and you pyramid. And you'll learn those things here. But these results I'm about to show you, you aren't going to get these types of results, okay? Now, I could have took myself right over to YouTube and showed you this stuff, okay? They don't need to see this, and you don't really need to see this stuff. But when you know what you're looking for, and you're building it up, and you build it up, and you build it up, you can do amazing things, folks. Amazing things. I'm not promising you're going to do this, okay? You won't take $5,000 and run up to $5.5 million in a couple months, okay? That takes a lot of ridiculous focus and just insanity to be able to pull that kind of stuff off, okay? That little bit of stuff you've seen here, this doesn't take an MT4 server to do it. You're seeing it here. Now you watch me call these markets every single week. You watch me do these things every single month. You watch me do this stuff day by day, calling certain things. You watch me show you executions and trade management. The same thing occurs on these lower time frames like this. This is high frequency trading. When you're able to get in here and execute based on the things you've learned, and you're looking at how the market's likely to deliver when they enter sell models and buy models on these lower time frames inside of the session, the morning session, the afternoon session. When you see that repeating over and over and over again, you can find a litany of setups that happen all the time. And you don't need to be forcing any trades. They're here. They're right in this time frame too. And it's not even a minute. It's 30 seconds. What's this right here? Order block, fair value gap, return to it. Takes out a short-term low, external range liquidity. Where's it likely to go to next? Well, you have this high here, and you have this high here, and you have this high here. So we dug down below that old high. Remember that red line there? That's what that is. So we had a retracement down in. This is that hourly consequent encroachment. Rally. Dig down, external range liquidity inside of a bullish market, because we're not trying to pick a top, right? So you had institutional order flow here. Breaker. See how it overlaps? Again, this is a 30-second chart. You can read institutional order flow on any time frame. The signatures repeat over and over and over again. Parlay more of your position because you got profits from here. You take those profits and you use it to buy more, but not larger positions. Like, in other words, you're not buying 10, then 20 more here. You're doing halves, halves, halves. And you do this multiple times. And you build up, and you build up, and you build up. You are years away from doing this kind of stuff, folks. And I know when I show this, it makes these dangling carrots for you to go out there and try to do that. And it's going to hurt you because it takes a lot of skill. It takes a lot of patience. You have to know what you're looking for. And you have to have removed a lot of things. And I wrestle with a lot of mental baggage. Obsessively compulsive. I'm bipolar. Come on now. If I can do this stuff, okay, I know some of you in here are very, very smart. Much smarter than I am. Academically, you've done way more than I have. You can do this. But you have to be fair with yourself and give yourself every advantage. I didn't learn this in 6 years. This took over a decade. It takes a lot of skill. But you don't need that kind of precision, that kind of performance, which is breakneck performance. You're not finding 2,000% in 1 week in Robin's Cup. And you're just not doing it. It ain't happening. Okay? In 7 days, 2,000%. And that's just working with 30-second and 1 minute charts. Doing a little bit of dabbling in the indices. That's all it is. One market. It's not even Forex. And this is not MT4, and you're not renting a TradingView server. Okay? So, as much as I want to go over to YouTube and rub everybody's face in this that thinks that I'm guilty of using a rented MT4 server back in my Twitter days, it's not required. Like, I mean, I'm flattered. Don't get me wrong. I'm flattered that they think that that's what I had to do that. But in 2,000% in 1 week, in 7 days, what do you think this account would have been in 8 weeks? It would have been more than I showed on Twitter. If you do this type of trading in a broker, all you're doing is asking for them to slip you, to give you issues with your fills. They're going to put speed bumps in front of you. You cannot perform with this degree of relentlessness. You have to just slowly work it in. When it's good, you juice it a little bit, and then you dial it back. And that takes a lot of discipline, because once you know how to do this, it's very easy to want to get out there and just Tommy gun it, like just lay waste to it. And you're going to get yourself not in trouble, okay, not like legal trouble, but you're going to get in trouble with your broker, okay? And you want to have a good relationship with your broker. This is why sometimes when I tell you that if you've had a really good run of just real high accuracy, it's worth it for you to throw very small trades in there just to mix it up a little bit and just take some small losses. It's good, okay? It throws off the folks that watch accounts that are smoking hot with their performance. And anybody that trades and they've been marginally profitable, when they hear me say that, they're like, this is nuts. Why would you even do that? Well, that's because these people don't make a lot of money, okay? And they don't understand the broker relationship that can be beneficial for you if you are once in a while just slugging it, just saying, well, you know, I'll put a 5 lot in here and just scratch a 20 pipper. Just when I know it's going to go up, likely to go up, I'll just go short. And it just makes it feel like, okay, this guy's just got a hot lick, and there's no reason to start messing with their fills. You know, going slow on their executions, you know, and slippage won't be as much. Those are the types of things that'll hurt you, and they will do it when your positions are at the highest. And they'll just say, well, we just didn't have the liquidity. Man, there's all kinds of liquidity. Okay, you're never going to get to the point where your liquidity isn't there for your trades. Okay, it ain't going to be there. Okay, that problem isn't ever going to be in your hands. But you have to have patience, folks. You have to have patience, and you have to just remember, I'm doing this with you every single day, week, month, for years now. There's no secret recipe book I'm reading from that tells me tomorrow's news. It's hard work and experience. Now I'm using those things to outline these markets with you before it happens. Then I show you results by going in and doing executions, and I share them on YouTube. But if they see me doing these things in the chart, they're going to pick up on signatures that I'm using. I'm not a rocket scientist. Okay, I bridged what I learned, how these algorithms operate, and I found things that repeat in the chart. That illumination came to me, I believe, by God. And I know that sounds nuts, but I couldn't see it otherwise. I knew these things were being delivered from an algorithmic standpoint, but I had to find a way to see if I could see just some things. And there's a lot of things I can't see because there's no way for me to see it in the chart. But a lot of things that I've taught, even on YouTube, are linked to that. But in the mentorship, it's really linked. Do you need everything? No, I'm proving you don't need everything. Everything that occurs in these smaller time frames is the same thing I'm teaching you on the 15-minute, the hourly chart, the daily chart. It's there. The missing piece of the puzzle is understanding the narrative. Why is it doing what it's doing? This is what I said on the YouTube channel the other day. You have to know why it's going to be going where it's going. What's the draw on liquidity and why should it get there? That takes someone teaching you every single day for weeks and months and years. And you learn by being immersed in that experience. And that's what mentorship is. I know it's hard. I know it's not easy for you to get it the first couple times you watch something. And you feel like you're right on the cusp of it. Like, I'm almost there. I can feel it happening, but it just simply won't happen. Right. That means you're so close. Don't quit. Because I stopped and called it quitting many times in the 90s. Oh man, I quit probably dozens of times. But once you're bit, you can't get it out of your system. You're never going to be happy because you know this is what you want to do. Okay, well, submit to it. Treat it as a hobby. Right now, you're treating it as a hobby while you're learning, with the expectation that once you understand what you're doing and you learn your hobby really well, what's the best advice somebody's given that has a lot of money? Use your passion and find a way to make it profitable and put a price tag on it. And you will never work a day in your life. Well, this is the same thing. If you look at this as a game or a hobby that you want to get really good at, like playing the guitar, which to me is impossible. I can't do it. But the long and short of it is this is something you can do because there's rules. And if you stick to those rules, it's not the word I'm looking for dexterity. It's not a dexterity thing like playing the guitar. I have dexterity issues. I just can't get my hands to do what they need to do. Some of you in here probably played the guitar and you're smiling and laughing thinking, yeah, guys, you lick there. I can play all kinds of stuff on the guitar. In price charts, there's finite details and rules that we follow. And if you submit to these things, you'll see them. And once you understand them, they repeat over and over. And there's a small little variance in how they deliver many times, but they're generally the same thing. At the same time of day, it's the same kind of formation of what it is you're looking for. But if you give yourself the permission to enjoy developing, not I have to have it done by this time because I'm losing my job, I need to pay my rent. You're asking for impossibility. You're asking for your own failure to be assured. And it doesn't feel like it should be like that, but it is. It's exactly like that because you're putting time right in front of you as a hurdle and you're never going to jump it. You can't get around it. There's no shortcut. So you just enjoy the time here. That's the reason why I've only put the payments in 1 year. And then that's it. Because it's going to take you time. And once you're in the community, you just kick it with everybody and you relax. And you'll learn. Once you take I guess the word is urgency out of this whole equation, it'll happen faster for you. It ain't going to be promised to you that you'll do what you see me doing here. Okay? I don't need fraud. I don't need gimmicks. I don't need, back-end stuff to make charts dance for me. I prove it to you. I go out. My name, my credibility is in your hands every single time I sit down with you. I have a report card every single week. Your attendance. Did I earn your attendance this week? Have I earned it the past month? The past 3 months? This entire year? The last several years? That's the question you need to ask. Do you see the things I'm using and teaching you here? Do they communicate to me? You may not see them yet, but am I being the mediator between what the algorithm is likely to do, using my tools as a language? Am I communicating to you what is likely to happen before it happens? Not all the time. There's a few times I get it wrong, but for the most part, it happens. That's where your focus should be, because I'm convinced that you're not going to find someone out there that can do this consistently, because they're trying to do signals and setups, or they're not even doing that, and they're talking about in hindsight. They're not telling you what's going to happen before it happens. I am in the hot seat every single time, and I don't mind it because I'm comfortable and I can do it. You will grow into that. And here's the wonderful thing. I am convinced, even knowing what I know and unwilling to teach, okay, there are things, and I know it makes you uncomfortable, but I'm being honest. There are certain things that I'm not going to touch on, and you probably say, well, you should have never brought it up. You're right, I probably should have never brought them up. But I'm honest to a fault. You are likely to be better than me using what I'm teaching you here. Remember, my weakest part of all my trading is the exits in profitable trades. Like, I want better exits. You may refine something that I've not been able to do and become so much better than I am. And I would love that. I wouldn't look at that as, oh, I'm inferior now. That's my whole point in teaching. I want to lift somebody else up and have a higher view than mine. That's what I want. And I want to be able to look up to that person or persons and say, I'm so thankful I had a small part in that person's success. And I'm proud of them that they took the things that I suffered through and made that with it. That's what I want. I want that with my children. But it's so frustrating they won't do it. They won't do it. So I have a lot of you that I look as my children. And you may be older than I am. And I'm not looking at you talking down to you. But a lot of you, like you've been recently in the last week or so, sending me lots of really nice emails. My staff pushes, this is a really nice one, read this one. This is a really nice one, read that one. And a lot of the men say, I'm like a father figure to them. And that's very heartwarming. And while I try to talk with the idea that you are my sons and my daughter, sometimes I'm talking like the individuals that I answered to the two gentlemen that sent me questions about like SMT and why does this not, work here or there, and why do the indices not move in concert with one another sometimes. I'm thinking of them when I'm answering the questions, and they know who they are, but I don't know what their face looks like. I just know that that's that person I received an email about, a question, and I wrote down as my hit list and covering certain things tonight in the video. They are in my mind when I'm talking, but you don't think of it like that. You think I'm talking to you. And I try to talk in a way where I'm hopefully received as personable, and it creates a rapport between us. So that way, not only am I not, I may very well be boring most of you, okay? But the folks that are really trying to make an effort and they have a student-teacher rapport with me that's beyond the average, like going to school, and nobody really cared about their teachers. But people that are very passionate and they're basically like hanging on every word I say, those individuals are going to do exceedingly well. Not because they're hanging on my every word, but because their attention to detail. That's how I was. Like every word that anybody said that I had respect for, I literally could still talk back to you and repeat like the videos that Larry Williams produced. I could almost tell you verbatim the things he says in each one of those 4 volumes. How he said it, his body language, that's how many times I watched it and how many times I wrote the notes out. So I get it. I understand that some of you are fanatical when it comes to studying my stuff. And others are not so fanatical and then don't put as much effort into it as they should. And then they want to find fault with either they should have got it sooner by now or this, that, and the other thing. You need to go back through the content again. And that's the answer. You have the videos, you have access to them, go through them again. And take copious notes. The writing down of notes is what brings it to your subconscious. Your subconscious is what your memory refers back to. So you can't have an empty subconscious vault of information and expect your brain to say, I know what it's going to do on this price chart, because you have not done the work. And I know that pisses some of you off. Oh, you don't know how many videos I watch. Watching videos is not how this is done. It's not. And watching a video and immediately trying to go out there and apply it with a live account is not how it's done. So you have to decide, are you going to listen and do the things I tell you to do and avoid the things I tell you not to do to give yourself the advantage and remove all the potential obstacles and pitfalls that everybody will fall victim to? I was, and everybody else that doesn't listen. They always send me the same emails. I wish I would have. I know. And it sucks that you got to go back through and try to ignore the bad habits that you created for yourself. But if you submit to it all the right way, do it that way, and say, I don't care how long it takes, I'm going to enjoy this process. Even if you get partially there while you're learning, the fact that this mentorship outlines what's likely to happen in terms of where the market's going to reach for, that in itself is a huge advantage. It's a huge advantage. It gives you the confidence, because not only do I have a track record with you all here doing it, but I'm pretty accurate. And I'm comfortable doing it. So let that be a form of confidence building for you. Don't lose sight of that. And it helps you along. Imagine if you didn't have that. Just like the folks over there on YouTube. Some people send me results and they're funded and they're doing really well. Really well. Because they put exceptional amount of effort in. And they blew out accounts. Lots of them. And they didn't stop. And now they found their niche. That's their model. And as much as they want to say thank you to me, like I gave that model to them, they earned that model. They fleshed it out using components and things that I taught. But the way they trade, that's their model. And they're so proud of it. They can't wait to share it with me. And it's fascinating to see what some of them have come up with very little moving parts. And others are very, very intricate. And they're making real money. How did they do it outside the mentorship? Yes, my mentorship stuff's been leaked around here and there, but they built it only on the things on that YouTube channel. What separates them from you? The time and effort they put into it. And they submitted to whatever time it took them. And some of them took a long time. Some of them were 2010 alumni from Baby Pips. And now, all of a sudden, they just recently found consistency and profitability. Do the math on that, friends and neighbors. That's over 10 years. Do you have the wherewithal to do that? I would suggest most of you don't. Most of you came in here in this last wave, riding on that 2021 train, thinking it's just going to fall right in your lap. It's going to be so easy, anybody can do it. And it's a lot of content, isn't it? And you haven't even gotten to charter yet. So it's literally like going through college here and getting your master's degree. It took me 6 years to do this. And that's how I did the mentorship. 6 years. Think about it. I started in 2016, 2017, 2018, 2019, 2020, 2021. 6 years. All planned. No, well, this, that. I had never, ever, ever plan to keep doing this the rest of my life. I've taken you through the exact travels, the pitfalls, the things that I had to endure. When you hear me telling these stories, all these things that I endured that year of my development. And I try to make it the same way it was for me, for you, for my kids. When they read my journals, they'll be able to say, oh, I can see why he was teaching like that time, that year. But COVID created some kind of creative obstacle course that kind of caused me to have analysis paralysis. Like last year was very difficult for me. Like I was not confident in any of my analysis. And to be honest, I second guessed myself a lot, because I didn't know how to interpret what was going on around the world. Like this is all new stuff, like all new kind of thing. But now I've got it behind me, and my content and concepts still worked really well. So I'm really confident now. So if I'm confident in it, knowing that we went through it together, you should feel confident. Not overconfident, not braggadocious, not arrogant, but you have things that work really, really well. These tools in trained hands are lethal. Not in the sense you're going to kill yourself in the account. You can, but you're going to be able to do things that the average person trading price action can't do. Your level of perception and price, reading it behind the scenes, what is it doing? Why is it doing what it's doing? Where's the turning points? Where's the precision elements that you would look for entering and exiting and adding new positions, moving your stop, when to move to stop? All those things come together once you've been here for a while. You need something short and sweet? That's already on YouTube. But you still have to practice with that. But just like everything else, when you go into a candy store, you went there for one particular candy bar, and you walk out with dozens of stuff. That's where you're at here. You're in Willy Wonka's chocolate factory. And there's all kinds of wonders to reach out and grab and play with and do this and that with. And if you don't use your time properly and structure what it is you're looking for, why you're looking to use that tool, like I talked tonight, SMT, that's a confirmation tool. It's not a timing tool. It's not a bias tool. It's something you look for when you already expect something bullish. You expect SMT diversions in the bullish sense because your analysis calls for that market to go higher. Then you start looking for, does this market reflect what I would expect to see in SMT? Notice what I just did there? You start with an idea or narrative. This market, the NASDAQ, should be bullish. It's going higher. It's going to create a higher high in the daily chart. So if it starts the day post 7 a.m. New York time and it's dropping down precipitously, that's a Judas swing. So what's it likely reaching for? What PD array, in the sense of a discount, could it be reaching for? There's that bullish order block we talked about. And does it stop there while other indices like S&P and the Dow go lower? Well, there you go. There's your confirmation. Buy the discount bullish order block because it's failing to go lower when the other weaker averages went lower. Done. Easier said than done, but done. Obviously, I could keep going on and on and on, but I don't want this video to be long. It's already too long. I could turn this thing into a 4-hour video and still have all kinds of energy and things to talk about. But I want you to remember what it is you're here for. You want to be independent. You don't want to be dependent on me. And I don't want you dependent on me. I want you to have something that you're confident in using, that you trust, that you've seen work. But how can you build any trust in anything you're learning here unless you yourself practice, backtest, log the results, good or bad, and retain these experiences in your journal and in your subconscious. That's the only way it jumps from your understanding to experience being able to do it. You have to input that in your subconscious. That happens by backtesting and logging. If you don't do those things, there's no way you can succeed here. Zero. There is absolutely no friggin' way you're going to learn this unless you submit to that. Backtesting? I don't want to do backtesting. Then you don't want to learn. That's the way it is. You can't build a healthy, fit body without exercise. Like I said, everybody wants a six-pack abs, but they don't want to do the work and remove the junk food. You want candy bars to give you abs and bonbons. It ain't going to work. You have to backtest. And when you backtest and you see the results of studying old moves and then you log them, you screen capture, you put annotations on them and signatures that you're looking for that repeat over and over and over again. And by repetition, you logging them and you writing the annotations on them, your subconscious logs that in your memory. And because you speak to yourself with positive self-talk in your annotations and in your journal entries, your brain receives that as experience that you never really had at that time. So it fools your brain into thinking, I've been there, done that. Then when you watch live price action, experience is drawn on by your subconscious. So those pseudo memories that you created by backtesting and logging, it refers back to that and the things that you hear me talk and say in these videos. So many times students say, I'm watching a video or I'm watching price action live. And all of a sudden I'm watching something for them and I hear your voice start coming up in my head. And then the market does exactly what it's supposed to do. So I'm remembering what you said. And it happens like you were in the room with me. Well, that's the same thing it was for me with Larry Williams. Same thing. That's learning. That's being mentored. That's someone placing their efforts in a repeating exercise with the hopes that that repetition is going to manifest itself in the future through experience. You can't shorten that. You can't speed it up. You can't have alternative ways to get it. It doesn't work any other way. It cannot work any other way. That's why 2016 members that are honest and they send me emails, they're the ones that constantly say, I haven't really done a lot of the back testing, but I really want this to work for me. And we go back and forth in email. I'm like, you keep doing nothing to improve it. And I tell you what to do, and you don't do those things, and it doesn't improve. Or if you tell me you did it, and I say, show me proof that you've done it, and you only showed me the last 3 days, and you got nothing beyond that, how can you say you're doing the work? Because that's not doing the work. It's frustrating to see that, because it's like, I don't have an answer for that. I don't have a solution for it other than what I've been saying. You have to do those things. How long will it take for you to click and see it? It's all unique. Everyone has it happen for them at different times. This is the reason why I'm honest and tell you, mentors that say they can have a timeline of when you're going to get it, they're full of shit. Okay, there's no way everybody can be pushed into a time horizon of receiving aptitude. You can't. So what I try to do is cultivate a relaxed state where you come in, you enjoy. Try to train yourself and teach yourself to enjoy backtesting and logging and studying old charts and being fascinated with the details. Fall in love with the precision elements that you're learning here, because if you do fall in love with that, you're going to be a freak when it comes to trading live price action. Like, you will be a wizard, completely astonishing to anyone watching you do it. And many of you want that. And that's how you get it. You got to be insanely interested in all of the mundane, stupid, boring stuff that happens in price. You want to be fascinated with every aspect of it. You want to know everything because you want to know that you know. Because when you do, you know. And you don't have any anxiety. You don't worry about missing moves. You don't care about what everybody else says about what you can do or can't do. It doesn't make a difference. None of those things can happen. You're bulletproof then. You're bulletproof. It doesn't matter if your market, goes belly up and, it gets screwed up like crude oil did, during COVID. Went negative $40 a barrel. That's something that you just don't see. Well, if you're an oil trader and you felt that there was too much risk there, do you just stop trading altogether? No. You take what you know about trading and you apply it to an indice, or you trade a currency or a commodity. You adapt. You don't need to be in a one asset, one trick pony mindset. That's why I made the decision once we got into the fall months that I would segue into indices, and it just happened to work out really good because Forex got a little boring there for a little while. But did we miss a beat? Nope. Using the same level of precision, same level of understanding about price action, just subtle different characteristics that now have to be applied with the indices. And it's fun. It's fun. And if you don't like these videos where I'm really communicating the characteristics of people that succeed here, if you can't draw on this and say, that's me, I have that same quality, you need to take some self-inventory. And maybe I'm not for you. Maybe you need to be out there trading, something more mechanical like, moving averages, like I taught initially on baby pips to teach bias. There's nothing wrong with that inherently. It just means you're likely to get caught in the market structure changes, and if you still trust those moving averages, you're going to have losses and they'll frustrate you. But if you're using a long-term price action model on weekly and daily charts for trending, they'll serve you well, but they won't serve you well in ranging markets. So you'll get beat up a lot there. Like the Turtles did when Richard Dennis trained them. Their largest losses were in markets that were in consolidation. But when they caught the trends, that's where they made all their millions and millions of dollars. They adhered to their rules. They knew they were going to get smashed in consolidation markets. They didn't care. Their money management protected them, and when they were in winners, they let them go. They didn't worry about getting out of them. And all they did was buy 20-day highs and sell short 20-day lows. That's it. That was the Turtle system. And that's why he bragged and said, I could teach anybody how to trade. And yeah, I can teach anybody how to trade too. But it doesn't mean they're going to take it and stick with it and adhere to the rules. How many times can you take a losing trade and still want to keep trading or have money left? So this is the hardest business in the world, but it's so freaking easy once you get to your understanding of what it is that you yourself are going to do, and you don't care anything about another market, another trader's approach to it, whatever I think is going to happen. You have your own model, your own market, your own view of what you're going to do to engage. Once you have that sense of liberty, that feeling of, man, I made this a lot harder than it had to be. Like, I was really stressing about all this stuff. And because you're trying and use every possible thing in your model. And when you look at the things I'm teaching, I'm not ringing in everything. And for some of you, you think the biggest barrier is, how does he know what tool to reach to get this information? Like, I don't know when to do that. Right, that's experience. And that's why trolls say he's got an answer for everything. He's got so many gadgets. Like Inspector Gadget, I got something in my pocket, like a Swiss Army knife. I got something I can explain the way I move. No, I have what the market's offering me. I have a range. And that range is going to have order blocks. It's going to have fair value gaps. It's going to have institutional order flow entry drills. Or it's not. Every price swing and every price move doesn't have every single PD array. But you need to know all of them to know this is what it's offering. Do you want to trade on it? If you don't, let it pass. How hard is that? For some of you, it's impossible because you're demanding too much of yourself too soon. And unfortunately, that's the reality. And it doesn't feel good. It doesn't feel warm and fuzzy because the onus is on you. I'm placing this stuff in your hands. I'm giving you an arsenal of weapons. I'm playing spotter every single week. Look down range and aim for this target right there. That's the hard part, submitting to that. How many times did you watch the markets this week and the things I said and you wanted to go the opposite direction? And then it didn't happen. It stings, doesn't it? And I have people in 2016 group that still want to do that. Still. And they send me emails and say, I don't know why I'm not getting anywhere. I'm going short on this bearish breaker, but I'm calling the market bullish. Giving you all the reasons why it's going to go higher. And I can appreciate someone wanting to go on their own steam, trying to carve out their own niche and do it on an independent basis. But man, if you're trying to swim against the tide, why would you want to do that? That defeats the whole purpose of why I'm doing these commentaries. I'm training you by lending you my experience. I'm giving you the reasons why it should go where I'm calling it to go. I'm making it as simple as I possibly can when I'm doing the bias aspect and where the draw and liquidity is on the higher time frame. I'm not lacing the chart up with every possible thing. I'm keeping it. You may not feel like it's short and sweet, especially when you listen to a video like this one, because remember, it wasn't supposed to be long. When you look at the approach, the way I outline the draw and liquidity, the bias, what you should be doing, mainly being in a buyer's camp or a seller's camp. I'm doing that to root you in to good soil. That way, you're not trying to go against the grain. You're not trying to swim upstream like a salmon. They get there, but once they spawn, they die. If you know what the tide is, you just relax and you go with it. It's a lot easier to get where you're going. You don't take a lot of effort to do it. And it's pleasurable, really. It's relaxing because you're not trying to reinvent the wheel. You're not trying to call tops. You're not trying to pick bottoms. It's liberating. But when you come into technical analysis and you see all this other garbage out there, it makes you think that this is not where it's at, when this is exactly where you should be. Realistic expectations, not my results, obviously. My results are extraordinary. But the idea of looking for setups that form consistently, they repeat every single week, I prove that. Back testing and logging in your journal, that's all on you. All of you have that responsibility. And if you have not found a way to fall in love with doing that, you got to do it. Because if you think that is an arduous task, it's monotonous, it's unproductive, it's a waste of time, because there's people out there that say journaling and backtesting is stupid. Okay. But you're not going to learn what it is I teach without doing that. It won't manifest itself in the charts to you. When, I don't know, it'll happen. But when you submit to it, something happens where one day you're literally studying and your understanding will change and you'll see, oh, that's what I've been looking for. And I didn't even know it. Many people come in here and they think they want to learn a specific thing. And because they do the things that I'm teaching them, they discover what they came in here looking to learn more about. They don't even trade with that. They trade with something else they've learned because of experience in backtesting and journaling. And it works for them and it's consistent and it fits their personality because they elected it. I didn't say, here, shove it down your throat. You're going to do it this way. And I'm going to pay you $500 for a good review. Yeah. So if you take this logic and you submit yourself to it, put in all the effort you can, reasonable effort, don't be obsessive about it. Balance your personal life with it as well. Enjoy being part of the community. It will happen for you. And if you're trying to force something that doesn't seem like it's working, put that down for a little while and try something else in the mentorship. And you'll find that that might be the very solution that you've been deferring because of stubbornness. And I understand stubbornness. I understand it intimately. I know they make roads after me one way. But you have to at least make a conscious effort to be diligent about backtesting, logging, and giving yourself that pseudo experience, because that is the bridge that takes you into reading the markets live and understanding the tape. As it's painting and printing new candles, what's it likely to do next and why should it do it? That comes because you've done thousands of backtesting. And that just doesn't sound, that sounds like a million sit-ups, doesn't it? It sounds like you can't have a candy bar the rest of your life and you need to do 1,000,000 sit-ups a week to get those six-pack abs. Well, if you want to look at it like that, that doesn't sound like anybody would want to do it. But if you look at it as, I got to do this set of 25 and rest for 30 seconds, and I got to do another one, that's a little bit more palatable. It's easier to say, well, that's what I got to do. And when you get hungry, I can't have that sweet. It's discipline. It's no different than what you're expected to do here. But you have to be disciplined. You can't be goofing around. The more you goof around, the more you defer doing what I'm telling you to do, the further away it is going to be before you get to where you want to be. You want to trade with live funds? That's never going to freaking happen. Not profitably. Until you submit to doing these things properly. Learn what it is that you're trying to do in price and what is your opportunity. What is your setup? What's your specific little thing that you'd like to look for in price action that you trade on? That's it. But you can't discover that until you put the effort into everything I've taught you here. So with that, I've talked your ear off. I probably put you both to sleep and or bored you to death. But this is good medicine, folks. This is some good stuff. And I wish someone would have talked to me like this when I was coming up, because I would have received it with gladness and thanksgiving, because I didn't have any of that. I had whatever a book would tell me, and it was basically BS. So this is the end of this one. I will touch base with you tomorrow. I'll have the video up. Hopefully, my goal is to have it up by 5 o'clock. I'm going to start trying to use the London close. I keep telling you I'm going to do this, but my wife and children end up getting me into something in the afternoon, and I can't get to the computers to do the markups or the notes. But I should have it up by 5 o'clock tomorrow. And until I talk to you then, be safe.